today. We know that there is a rift between the Shias and the Sunni, and let me put it this way: there is a rift between Iran and the Arabs. The Arabs desperately want prices to go higher because they are eyeing an IPO. Iran, frankly, has not participated in the last oil bull cycle, so they are very keen that when oil prices are higher, they should be allowed to pump out much more oil. Because of sanctions, they were not able to really capitalize on the previous bull market. Ole Hansen, head of commodity strategy with Saxo Bank, joins us now. Ole, the way crude prices have come down in last 2 weeks, it is evident that markets are betting on a increase on the output, which currently OPEC seems to be cutting down on purpose. Do you think that OPEC would be looking at giving some indication on a possible increase in output?
Yes, I believe they will, and I think it's more or less a done deal. We saw from the technical meeting last night that they were discussing raising production by 1 million barrels, which effectively, as you mentioned, could lead to an increase around 600,000 barrels a day. I think what's important here to really highlight is that this is not changing the deal from 2016. They're keeping the production cap. The only thing they're doing is basically returning the barrels to the market that has been lost, especially from the slowdown in production in Venezuela. So I think by keeping the deal unchanged and only bringing the compliance back closer to 100%, I think it is a deal that most members will be willing to accept.
Ole, I know it's a long shot and a far cry right now, but what are the chances of there being a no deal sort of a situation?
That obviously cannot be ruled out at all. But even though we know that the OPEC has to be unison in their decisions, we have seen in the past that a rejection from some members had not prevented, especially Saudi Arabia, from going it alone. And I think that potentially could be the case once again. I think Saudi Arabia and Russia have clearly indicated that they are prepared to increase prices. We have seen in recent months the divergence in monetary policies between the U.S. and the rest of the world, the tightening the U.S., how it's starting to put some strain on the global economy, and Saudi Arabia, they are fully aware of this, and the potential negative impact of oil prices rising at the same time as we have currency weakness hitting many, especially emerging market economies. So production needs to be kept at a level which is sufficient in order to avoid a spike to the upside.
Probability of this production rising, but over a period of say medium term, that oil still continues to rise and probably moves towards what you mentioned about Saudi expecting or are anticipating prices to be much higher than current levels.
Well, I think the line in the sand was really signaled when we started to test $80 back last month in Brent crude. That's when the talk about raising production started to emerge. We have seen fuel protests in several major economies in recent weeks and months, and I think that basically spurred them into action, especially just to bring the compliance down to 100. So our preferred price range for now is low 70s to low 80s, 71, 82-ish. I think the short-term focus, once we pass this meeting, will once again be on supply and the lack of it due to the unquantifiable the quantities that could be impacted by U.S. sanctions on Iran. But I think as we move deeper towards the end of the year, demand is starting to become a theme. Especially the risk of demand growth starting to slow. Trade sanctions could have quite a significant impact of this. Continued monetary divergence in the policies is going to put some additional strain. So I think we are in the 70 ballpark, rough numbers, $70 to $80 range here.
Okay. Well, I appreciate your time. Thank you for joining us.